Hello and I welcome you to today's special Black Friday special webinar topic behavioral finance and how to use it in your trading. My name is Sinclair and I'm I'm very happy to be here today with you and share with you some thoughts on a very exciting topic called behavioral finance. So in fact, you might have come across the secret trading room from JFD brokers at the JFD website and found out there about a PDF which was published there, and probably have read through it. And the topic of today's special webinar here is exactly that, behavioral finance, and get a deeper look behind the scenes, how to use it in your trading. So first of all, here, look at the risk disclaimer, and once we are ready here with that, we'll start with a very exciting question. So why do retail traders do what they do, and why do they hold too long on long positions, on losing positions? They hold too long on losing positions, I'm sorry, and cut winners short. And this is something you may have wondered yourself, found out in your trading. So it's the end of the year. Probably you have scrolled through your trading journal. Probably you have had a look here at your trading station, and there you have the chance to get the history of your trades in 2017 so far. And you probably have wondered how it comes that after a series of trades, so we're not talking, let's say, about 10 trades, but 100, 200 trades or so, if you're an intraday day trader, that probably here you came across the fact that your winning trades on average are smaller than your losing trades are. So if you carefully look at these two components in your trading, that's not just necessarily because of your trading approach. So some might argue now, they say, hey, I'm a scalper, so that's not unusual to probably have a risk which is a little bigger here to avoid position your stop here into the noise of the market, let's say, and having the risk of getting stopped out. And that's why my average losing trade is slightly bigger, whatever slightly means in that context here, than my average winning trade. And I can compensate this thanks to a high hit rate. But in fact, nevertheless, it's not just something scalping traders will see, but also swing traders will probably see. Traders having a bigger time frame they are covering with their trading. And so in this context, behavioral finance comes into play. And what we definitely know is that psychology in trading plays a crucial role. And here emotions, especially like anger, frustration, fear, self-confidence and ego, motivation, actionism. And in fact, based on my personal experience, and I'm in the markets for, I don't know, something around and over 10 years now, I can say that also based on my experience as a trading coach, as a trader myself, being in conversations with lots of interested people in trading itself, that fear is and was one of the main topics here, respectively main emotion, which played a crucial role, especially the fear of losing and the so-called loss aversion, which plays a crucial role here in this presentation. And so in fact, based on that, on those emotions, especially based on fear, but also based on other aspects here, we get to see so-called cognitive biases. And what do I mean by that, or what is meant by that? It's systematically and flawed tendencies when it comes to perceptions, remembering, thinking, and judging, which impacts your trading in a negative way. So what I want to do here is, and I've prepared this already, I want to, oh no, that wasn't good. One second, please. I just closed the window. I just closed the window, which I've already prepared here for you to guide you through the PDF you may have downloaded. And now, unfortunately, and that was the reason why I prepared it already, it takes a few seconds now, but let's see, 1 second. So let's go that way here. So first of all, here is the tab with the secret trading room, and there you can see I'm already logged in, obviously. There you can see here, if you scroll down a little, a unique ebook just for you. And this unique ebook, if you open it, there are some cognitive biases described in it. So you can see this here under 2. And I just want to give you some examples here on how such cognitive biases, how they could look like here. So for example, there were in the 1980s, there were 3 guys. One of them is, by the way, Amos Tversky. Amos Tversky is a former colleague and one of the guys who got a Nobel Prize here on his work on the prospect theory. He got it, this Nobel Prize, he won it together with Daniel Kahneman. Daniel Kahneman is probably one of the best trading books authors out there, trading book authors out there, even though some people might not see this as a trading book, but in fact it is. And everything on this topic is covered in this book, Thinking Fast, Thinking Slow, from Daniel Kahneman. And I highly recommend reading this book because you will find yourself in several spots here without knowing this guy and this guy not knowing you, but he's describing things you face in your daily life, but also in your trading, and you will be used to several of the examples described in this book. And I highly recommend it because it's one of the best trading books out there. If someone asks me, okay, can you recommend a trading book? The first book I recommend is Thinking Fast and Slow from Kahneman. Second is Market Wizard, the Market Wizard series from Schwager. But this is one of the first trading books you should have read here, even though it's not covering anything in terms of trading, in fact. But let's come back here to this concept of cognitive biases. So these concepts of cognitive biases are also described in the book, by the way. And so let's come back here to the 80s and point 1. So in the 1980s, Thomas Gilovich, Robert Malone, and Amos Tversky did some research on the phenomenon of the so-called hot hand. And you're definitely familiar with this because it's not necessarily connected to basketball, but it's also connected, for example, to soccer. Or other sports you may be interested in. And this phenomenon is about the question whether a player has a higher chance of scoring if he scored several times before. So some might say now, okay, my favorite soccer player is whoever, and he is running really hot right now because in the first 10 games of the season he scored 11 times, so it's highly likely that he will score in the 11th game too. In fact, this phenomenon has never been proven by anyone and is something traders may recall in some situations where they strongly believe that there's something like a hot hand or a run, not just in terms of winning, but also in terms of losing here, meaning that the probability of having a winning or losing trade in front of you is higher if you won, respectively lost before. And by the way, I can definitely tell that this is true. So there were times when I had losing streaks when I somehow knew before that I will be stopped out because I was stopped out before. Even then, if the chances of winning are significantly higher, or respectively, the chances of winning are usually higher than of losing. Some may recall this, by the way. Probably hear some poker players, online poker players, and listening to this right now. They know this phenomenon too. So, like, have you ever been on tilt? I bet you have. And now imagine you've lost a big pot to someone before because, yeah, your aces were correct. Let's say we're playing no limit hold'em and your aces were correct. And you usually have, against any two, a probability of 80% of the cases you're winning. But then you had a streak of running really bad, and so you went all in with whatever amount, and you were showing aces while your opponent was flipping over, let's say a very optimal scenario, flipping over ace king. You're 90% ahead, and then he flops the straight. It's 10 jack queen, boom, he has the straight and he wins the pot. So the thing is that you knew this before, that this will happen because you lost several times before. But, and this is the thing, it's a cognitive biases, okay? So it's not proven. There's no such thing than that there's a connection between those two, and you can easily adapt this to trading yourself. If you have a hot run here, and if you're let's say you're a winner like right now, and you have won 5, 6, 7 times in a row, it does not mean that you will be successful the next trade. And you have always remember yourself here and induce rationality. To really make sure that you're not a victim of these cognitive biases. But it's just one example here. Another is there's a smooth transition, in fact, here to another cognitive biases, which is called illusion of control. Here, there's a belief that you are capable of influencing or calling certain developments, even though we know that this is not possible. So saying if the market goes up or down. In trading, this illusion is, in fact, highly common. Yes, many traders, especially beginners, by the way, believe that trading is about calling the direction of the market. That it is not can easily be seen when, for example, stepping back and looking at the fact that, for example, the FX market, if you're trading Forex here, we have a higher, an average higher than 5 trillion USD days there per day. So it means the average trading volume here in the FX market is 5 trillion USD and higher than that. And now just imagine, or really, you have to ask yourself, is it really realistic to call the direction of the market, to really call whether the market will go up or down here, and that you are capable of really knowing which motivation drives certain market participants here in the market? I think everyone will answer this question with a clear no here. There's also something you might recall in your trading, a cognitive bias, which is also based on the illusion of control somehow. It's the so-called hindsight bias. So here we have a consequent and systematic wrong memory of our made calls in the past. So I really like to give an example here based on what happened nearly 1 year ago with the election of Donald Trump in the US. If I asked you, let's say in June, July 2016, how likely do you think it is that Donald Trump will be the 45th president of the United States? You may have said, you have to write it down here on a sheet of paper, and you probably might have said, hey, probably it's something like 30%. Let's say yes, there's some chance because of also something which is a cognitive bias, by the way. You were looking at developments around Brexit here at the end of June last year, so you might say, hey, yes, probably he has a chance. But you wouldn't have said that he will definitely be the next president of the United States. There was enough skepticism and something where you say, well, they won't let this happen here. So if I asked you the same question again, let's say, yeah, at the 10th, 11th of November, and you say, hey, how big did you think the chances were that Trump gets elected? If I ask you now, and let's say, well, you have to answer this question here 4 months before today, so let's say somewhere in July, you might have said something like 80%. Yes, definitely. So it was clear that he gets elected. I mean, look at what happened here around Brexit and so on and so on and so on. The funny thing is that this can easily be adapted to trading here. For example, how many times did you found yourself, probably right now, looking at the developments here in Bitcoins? How many times did you found yourself today already here saying, hey, you know what? I knew it. I knew that Bitcoin rather sooner than later will hit 10,000. So by the way, here, I think it's GDEX. We haven't seen 10,000 so far. There are other exchanges here of Bitcoin exchanges where we already see, respectively saw 10,000 USD, by the way. So, but the thing is, how many times did you find yourself here today probably already saying exactly that. Yes, well, sure that Bitcoin will make it up to 10,000. The thing is, if you were that sure, why didn't you went long? Why didn't you went long here on the pullback, let's say, back to these former highs here, towards the region around 5,000? I mean, this is a nearly double up in no time. We're talking about 2 weeks here from nearly 5,000, okay, 5,500, but it's a nearly double up to 10,000. If you were that sure about this development here, well, there's only one thing you have to do, you should have done here. It's going long. But the thing is, you weren't that sure because you were seeing those candles here at the beginning of November, and we're saying, hey, you know what, this is the top. Now from here we will go down. Well, obviously we didn't go down, but in fact the market pushed higher and up to 10,000. But the thing is that this is also something we know as a cognitive biases, and which can and definitely will influence your trading in a negative way. Also here, another cognitive bias, the last one in this example here, and then we'll move forward and move on here with the content. It's the so-called self-serving bias. So here we talk about the natural tendency of people to credit themselves when something good is happening and blame others when something bad occurs. So how many times did this happen to you? You had a winning trade and you were the greatest trader of all time because you did the right choice and you went long, let's say, and now the market moved up, you closed the position with a big profit, and you felt like the king, like the one who just did it. And how many times did it happen, on the other hand, that you went long, the market collapsed, you saw a significant loss here. Hopefully you set a stop, and so you were stopped out here, and you cut your losing trade short. Nevertheless, how many times did you find yourself in a spot where you then said, yeah, well, what shall I do? Goldman Sachs just sold the market aggressively because of this and that. They want to manipulate here again and all that stuff. So it's not because you did the wrong choice here and went long, but it was someone else. Or Mario Draghi announced this and that, or Janet Yellen did this and that and said this and that, and so no one could see this coming, and that's why the market just dropped. It's not you who made the mistake, but it was someone else who made you look bad right now and look like a fool because you were on the wrong side of the trade. That's also something which will definitely impact your trading in a very negative way, so-called self-serving bias. So all these things, all these examples, they cover a topic called cognitive biases, systematically and flawed tendencies when it comes to percipients, remembering, thinking, and judging, and this impacts your trading in a negative way. Now we could easily end this presentation here and just say, okay, well, that's it. Nice to hear that. And so I have to really be careful when I make a decision because I could I could be a victim here to cognitive biases. But I think you won't remember this after, let's say, 1 week, because you will probably write down something here and then say, okay, let's go home and then study this, and probably it will help me in my trading if it doesn't well, okay? And that's one of the reasons why I want to make this something more practical here. So first of all, let's have a look here at a real problem. So I'm not just telling you this, that these cognitive biases can impact your trading in a negative way, but it's not just that they can impact your trading in a negative way, but they do impact them, or impact your trading in a negative way. And that's something you can find here in this chart. So it's data from a third-party broker. It's not JFD, but it's covering, I think it's something like 50 million trades during the time span from the 31st of March 2014 till the 31st of March 2015. And in fact, the thing is that now you could say, well, this is just one example. Doesn't necessarily mean that it's also been the case before or is still today. Very interesting fact, I have to mention this. So I'm also a book author. So I was asked from a big book publisher here in Germany whether I'm interested in writing a book here, especially on FX markets, and I decided to do so. And they said, well, you say which topic you want to cover, just write about it and we'll publish this book. And so I decided to write about sentiment and trading, the sentiment in FX trading here especially, because in the FX market that's also a very interesting topic, since the FX market is a mainly decentralized market. So we do not have one stock exchange here, which shows clear data in terms of volume at a certain level. But in fact, we have to help out here, help us out here by, for example, looking at the position of several market participants, let's say at other brokers, or at my broker here, which is JFD. And so I look at the position. That's what I want to say. That's why I look at the position of those market participants here to try to profit from those cognitive biases just presented to you here. And so in fact, when I wrote this book, I used a chart from Q4 2009 till end of Q3 2010. So 4 years before. The only thing which changed here in the meantime were the asset considered here, but everything else in terms of loss aversion, meaning the average winning trade is at somehow half of the size of the average losing trade, stayed the same. So in fact, what you can see here, for example, at the left side here, this is Euro USD, those two columns here. We are covering 9.5 million trades here, nearly, roughly. And what you can see is that the average winning trade was something like 20 pips, while the average losing trade was 40 pips. So in fact, this is, by the way, something which you will find out in the book when reading Thinking Fast, Thinking Slow from Kahneman, in which they got the, their Nobel Prize for. You usually have this ratio of 1 to 2 here, meaning nothing more than usually the retail trader in terms of trading, but also a human being, tends to feel twice as much pain in case of losing than he feels joy in case of winning. So, or let's put it in the other way around, to make up for a loss of €1, for example, so you're losing €1 right now, you have to make twice as much money to feel the same level of joy, which means you have to make €2 then. And this is something you can perfectly see here in this chart, because this is another way of expressing this ratio of 1 to 2 here and the loss aversion, which is completely natural. So it's definitely a real problem. It's nothing we can only put a stamp on and say, hey, okay, that's a nice theoretical approach here, but this is something you will face in the real world. So, well, this is right then the point where you can end this presentation. No, I mean, now you have a graphic. You can say, okay, I got the point, and I have a chart here exactly showing me that this is really a real problem. So yes, okay, I will be careful in the future and try to be not a victim of this cognitive biases. Of these cognitive biases, especially loss aversion. Try to induce rationality once I feel call it emotion here, or the willingness to take my winning trade here out of the market, because I just don't want to give back any of my gains, which I've seen so far. Respectively, I try not to take out any stops here and hope that the market will turn around. And I try to be disciplined here, take the loss, and be fine with that, and then try to make up for this one loss with one bigger gain here, and having 2 trades, one winning, one losing trade. But while the average winning trade was bigger than the average losing trade, I'm still coming out with a profit here. Yes, you could easily do this, and in fact, I can tell you a story. As a trading coach, I had a student who booked me as a trading coach, and then we came to the section of trading psychology. So we had several sessions together, and I tried really to explain to him that trading psychology is a really important topic. And we were also coming here to this topic around behavioral finance, and really went into more detail than I do here, obviously. I mean, if I have several hours instead of just 1 hour, there's way more chances for me to explain certain things. And now the interesting thing was that he looked at me, and he became really, he really wanted to move on. And he looked at me and said, hey, Jens, can we just fasten things up here? Can we just skip this psychology stuff here? I mean, well, I got the point. So if I have a profitable and proven profitable trading strategy, I can just follow it and everything should be fine, right? So I don't have a big deal here. So since I know that the strategy is profitable, and I just trade the strategy, and so there won't be any psychological, let's call them tripping hazards, I can be a victim of, right? And I said, no, you just can't, because the thing is, for example, I myself, as a professional trader, money manager, managing clients' money and doing this for quite a while now, I myself feel sick to my stomach when I see a winning position, for example, giving back some of the gains here I've seen so far. Let's say the market moves in my direction and I'm ahead, like, I don't know, 5,000 euros. And then the market comes back, and it comes back 2,000 euros. So not even 50%. So I'm not ahead 5K anymore, but I'm just only ahead 3K anymore. 3K only. And well, I can definitely tell you one thing. I feel sick to my stomach, because I think, well, would have been a great idea to take out the winning trade here somewhere around, let's say, 5,000 euros. And I would be ahead another 2 grand here. Not sure whether the market will move to new highs and all that stuff, or new lows, depends on whether I'm long or short. And the thing is that it's really tough also for me to really stay calm here. I mean, the more often you do this, the more calm you become. So that's definitely something which is true. And you can really spot, if you see me trading and would stand right next to me and look at me, you won't recall whether I'm right now winning or losing. Okay, so you just don't see it, because, and this is the next thing, but it's not topic here. But somehow it could be a topic here too. It's because I manage my so-called effective leverage accordingly. Meaning, if I don't trade with huge amounts of money I can't afford to lose, for example, or risking, even though I can't afford to lose it, but risking to really see a significant drawdown in my equity curve here, well, then I definitely have an advantage, especially towards my competitors, because if I can really afford those losses here, well, I'm not going completely crazy here once the market moves them against me, for example. So I want to give you an example. I am not showing you a chart right here, but right now, for example, I am short gold, and gold is moving in the other direction. So I'm right now seeing a loss here. But even that doesn't really scare me. That's very easy. Why? Because the position size is just small enough. And I exactly know, even if I'm getting stopped out here on this trade, I'm only losing 0.6, 0.7% of the equity I'm trading. And having this in mind here gives me an enormous advantage compared to my competitors in trading, because I can easily hold on my positions and stay rational here. So, and this is one thing, and I want to close the cycle here with the example of my student here. So he came and said, hey, I don't have this phenomenon of loss aversion here and cognitive biases and that stuff. No, that's not a big deal with me. And at the end, he, as a client, he's the king. And if he tells me he wants just a trading strategy and I should guide him through this, well, I do this. Even though it didn't feel right here, right, at this moment. And so yeah, he moved on, and so far I think he's doing quite well. And then something interesting happened. One evening, I got a call from him. He called me and said, Jens, I face some difficulties in my mental stability when trading. So once the market moves in my direction, everything's fine. But if it moves against me, well, I just go completely berserk here, and sometimes I really take out winning positions here, which would have, if I've kept them, made me enormous amounts of money. But instead, I wasn't capable of taking the pain here. And I told him, hey, you just told me nearly, I think, 6 months ago or so that loss aversion is not a big deal with you. So I felt some kind of let's say confidence here, even though this is not very professional, but this is exactly the thing. So what he was describing was what he didn't want to believe here to be part of his daily trading, but it is definitely true. And this chart perfectly illustrates exactly that. Even though if we end the presentation here, well, you won't probably take anything with you here, but only the chart, screenshot it and say, okay, it's a problem. Well, I take care of it. That's it. Try to induce rationality. There we go. But now what I want to do is I want to play a game with you. 2 games, in fact, and I've prepared them here at the next slide. So what I want to do with you is to choose an option. one for game 1 and one for game 2. And in fact, here, please do consider those games to be independently from each other. So they have nothing to do with each other, even though they're here standing on one slide. Okay, so game 1 is simple. Choose between these two options. Option A is you get right here 900 euros from me. So you're sitting in front of your screen. Just imagine we have some kind of well, let's work it with bitcoins here, and I can easily send you some bitcoins here of something like 900 euros. Or second chance, or second choice, option B is you have a 90% chance of getting 1,000 euros. So instead of 900, 1,000 euros, but there's a 10% chance of getting nothing at all. And the question is, which option do you choose? I played this game again at the World of Trading 1.5 weeks ago. This is the biggest trade fair in Germany here on trading. And in fact, I have already a clear idea of which option you choose in game 1, but I've also have a clear picture in mind which option you choose in game 2. And here it comes to losing. You choose between two options. Right here, you just give me 900 euros and that's it. Or you have a 90% chance of losing 1,000 euros, but 10% chance of losing nothing at all. And we just move on, as we did here in option B, for example, where you didn't get anything from me, and option B, in 10% of the cases, I don't get anything from you. And also here, question is, which option do you choose? So what I can tell is that usually in game 1, around 60, it's more like 70%. At the World of Trading in Frankfurt, it was more than 80%. Choose option A. So you get right here 900 euros from me. That was the option which in fact 90% of the people choose, and it's the same here. So I bet that this is exact the same answer you will give me here. While in game 2, usually, and that was also the case in Frankfurt, that was a room full of 50 people and it was only 2 which choose option A, while all the others choose option B. And I can clearly say why you did this. In case of game 1, you said, well, it doesn't make a difference, right? From an expected value perspective, in both cases, the expected value is 900 euros. So it's 900 euros here minus 0. You're not losing, winning anything more or than that. And here, 90% chance of getting 1,000 is 90% multiplied with 1,000. It's 900 minus 10% multiplied with 0. It's 0. So it's 900 euros in both cases. Same thing here. So it's no psychological game I'm playing here with other cognitive biases or so. And but the thing is that here you just grab 900 euros instead of saying I'm going for 1,000 euros here and I gamble. Well, you just don't gamble. Same thing is true here for option A, respectively B in game 2. While here, most of the people go for option B, and the main motivation they go for option B is very simple. They say, hey, if I lose 900 or if I lose 1,000 euros, it doesn't make a difference. It's just 100 euros more. So at least in game or option B, game 2, option B, I have a 10% chance of losing nothing at all. And why not trying to get exactly that? And by the way, we considered winning, we considered losing. While you grab the winner right here, what did you do with the losing trade? Well, you let it run, at least another 100 euros. And you've seen this before. You've seen it here in this chart. Grabbing the winning trade fast, letting the losing trade run. It's very simple and it's human. It's not that I'm playing any games with you and that if you're kind of, I don't know, rocket scientist here, moving or going to university and being really smart, considered really smart, really intelligent, and so that has nothing to do with intelligence. It's just human. It's a complete natural human behavior. And we are all victims to exactly that. That's what we call cognitive biases. So now the thing is, I've held this presentation also in Germany several times already. And the thing now is that even though you probably might see the connection between this game here and the trading related example, Nevertheless, there was one guy in Munich who came over to me and said, really great presentation, I really enjoyed it, and really great game, and it got me, the concept became even more clear than after playing that game. But the problem is, he said, the problem is that I'm not sure whether people really get the connection between this example here and trading. So probably you should include some trading related example. And after thinking for a while, I thought, yeah, this is definitely right. So probably this is exactly what we should do. And therefore, let's take a look here at a trading related example. So it's very simple, in fact. It's higher highs and higher lows. So it's the structure of an uptrend, higher highs and higher lows. And what you usually do is, it's a basic concept, in fact. You just buy the break to new highs here with the entry point for a long position. You place the stop here below the last relative low. It is, as long as you trade below those highs here, by the way, it's a swing low. But the moment the market moves to new highs, we not talking about the swing, but the relative low then. This is where we have to stop, and now you can see the market moves in your direction. So that's the phase of gaining profits here, in fact, and then the market starts to correct some of these gains here, because it has to build a structure of higher highs and higher lows. Rather sooner or later, the market will have to come back, even because else we won't see any new relative lows developing here. So from here, hopefully the market will turn around again, make new highs, and then this is then the last relative low here. And we can move our stop to this level. The only problem is, even though this concept is very easy, most of the people just can't do this from a mental perspective. And the reason for that is very simple. In fact, when the market here moves in your direction, well, again, you probably feel some kind of joy that the market moves your direction, but, and this is the thing, it's not something spectacular. And we also come back to the cognitive bias in terms of self-serving. You remember that, what I already presented to you here. Remember that when I called this self-serving bias, yeah, it's self-serving. You are responsible for the winning trade, and so you feel great about yourself, but it's not that you become completely enthusiastic here or so, but it's just like, well, that's the way it is, right? Because, well, I'm the greatest. It sounds ridiculous, but this is a big problem, ego problem. Many retail traders, especially beginners, face here. And now you see the market moving against you, and you start to really feel big pain. Remember the ratio of 1 to 2. So in fact, when the market here comes back 50%, so let's say the market moves 500 euros in your direction, and then it comes back 250 euros here, it feels like you're here, even though you're still ahead 250 euros. Okay, so you enter the position here, and if the market is here, that means that you're still ahead 50% here of 500 euros, which is 250. It feels like you're ahead no dime. It's plus minus zero. It's near break even, because the losses feel twice as hard and painful as you enjoyed of being on the right side of the trade. So meaning, if the market moves back 250 euros, it feels like 500 euros. You just lost, and the market corrected 500 euros here. If it keeps on moving lower, if it comes back to the break-even point, so here to the same level where you entered the position, it doesn't feel like you gave back 500 euros, but it feels way more horrible than that. It feels like you just lost 1,000. So, or you're behind 500 euros because of this ratio of 1 to 2. Average winning trade, respectively average losing trade. So what you usually do is that you feel sick to your stomach, and here somewhere there you just throw in the towel and you just say, okay, I take the last points here just to be ahead several euros, and to make sure that at least I cover the commission here, and that's it. So, well, it's probably 100 euros left. The problem is, when you enter the position here, you play the same game on the other side, and you're probably taking the stop lower from here. If the market does not break out here in your direction, but it's moving lower from here, and then you say, well, but finally still the market is long, and so, well, probably I should take out the stop here. That's what we call a shadow stop then, by the way, or alibi stops. A shadow stop, you can't catch your own shadow. That's the same thing with a shadow stop. So you probably place the stop here, but you just take it out, or you just move it lower here to make sure that you're not getting stopped out, because rather sooner or later the market has to turn around, right? And there's the hope that the market will do exactly that. The problem is that while you're here taking small gains, you have the problem of probably also averaging down in your losing position, but this is something we won't cover here, and that's definitely something which will make things even worse. But what you will see is on average bigger losses than that. And this is exactly the same thing as we did here, or illustrate here with this example. You get the 900 euros, you just grab it, you make winning trades smaller. By the way, we worked with a retracement here. It's the same is true if you enter the position here with a too big position size. You probably take out the position somewhere here because you say, hey, cool, I'm ahead now. I something make like 10 to 20% on my trading account, even though I risked, by the way, nearly everything and went all in here with the last money I had in my trading account. But then you're just going for those small and quick gains here. And with this in mind, you can clearly see that the average winning trade, because of the principle of loss aversion, will be naturally bigger than your average losing trade. Will be smaller than the average losing trade, that way around. So that's the trading related example. So now I want to work with you through a table here, which is also covered in the book Thinking Fast and Slow from Kahneman. And you can see this here right at the introduction. The following is based on Kahneman's best-selling book Thinking Fast, Thinking Slow, which I highly recommend here. It's one of the best trading books out there without having something to do with trading at all at first glance. So exactly what I already told you. So we have 4 cases which illustrate this kind of, or this principle of loss aversion, even though I can say somehow 3 of those 4 cases are still okay. It's still a loss aversion, it's a cognitive bias, and you will naturally, if you don't overcome it, have not the optimal result in your trading in terms of the expected value, what to expect. But at least you can say, if you cover those 3 cases well, you have a good chance to probably still be around in, let's say, 1 year from now. While there's one case, it's the risky bet in the case of losing. We call this sunk cost fallacy, will definitely kill you. But first of all, let's have a look here to illustrate this concept of loss aversion a little better to you here. Also, in case of winning, high probability, you have a 95% chance of winning 10 grand. Do you go for a break of a crucial level to get another 10,000? So this is an even more aggressive example of the game 1 option B scenario here. So you gamble in the game, you gamble for another 100 euros. Here it's I made it more aggressive, and to illustrate it a little better, you gamble for another 10 grand here. And usually people don't do this here, even though this is not really bad. Nevertheless, this will take you to a next level if you can really make your average winning trades that significantly bigger here while stabilizing the hit rate. This will definitely bring you ahead in terms of expected value. It's a more positive expected value you can expect then. So you probably still already have a positive expected value here when trading that way. But if you want to bring your trading to the next level, or let's say you have to overcome this problem, let's say you're a break-even trader after commissions and everything, so you're plus minus 0 here. The thing is, if you can overcome this aversion to, I put this in quotation marks here, gambling. If you can overcome this aversion to gamble, but say, okay, I go for bigger gains here, this can definitely bring your trading to the next level and make you then profitable in the long run. But this is also the other game here. It's a case of losing. 5% chance of losing 10 grand. You feel the loss even though it's unlikely, and that results in fast profit taking. That's also something I already mentioned here. When you say I'm taking a too big position, yes, in relation to my trading equity, and then I see the market moving, let's say 10 points in my direction, which equals to let's say 10-20% gain of my traded equity, of my trading account, while I'm willing to risk my whole bankroll on this one trade. In the long run, there will be an occasion where the market won't come back and it moves against you right from the start, and it won't come back and will kill your account. So all in all, even if you take all those small gains here, at the end you will definitely be broke and ruin your account here. And so this is, by the way, also the thing. It's the other side of this coin. So if you have 5% of losing, even though it's unlikely, you usually don't take the risk here. It's also loss aversion at its best here. Now let's have a look here at the small probability risky bets. The thing is, this is one of those examples where we usually talk about something we call asymmetrical risk reward, and very aggressive risk reward ratios. You have a 5% chance of, let's say, 10 grand, similar to playing lotto, and then you go for it. That's usually true, especially for men, since boys will be boys. It's just the way it is, and it's completely fine. And I'm, by the way, fine with that, because I myself love to do these small games here and sometimes play some lotto and so on. Just imagine you're just giving away €2. It doesn't make a difference to you, and at the end you're coming out like ahead 50 million or so. And nevertheless, some people do this way too aggressive and too often. So there's so many cases when some traders say, okay, I'm betting on the market bottoming out here, for example, and taking just 10 points risk. And then they take the trade, boom, they are stopped out with 10 points. Then we do this again and again and again and again. And the thing is, this can result in really make you frustrated, really frustrated. And then the next time, the time when you should have taken the bet, because then the market is really topping or bottoming out, depends on whether it's going long or short, and really moves aggressively in your direction, then you don't take the bet anymore because you said, hey, I failed so many times on this. And this is the problem with that. If you can overcome this, nevertheless, it can be a profitable approach, even though from a mental perspective, you have to be very, very very strong character here and really know what you do. And now the fourth case is the case of losing, and it's the small probability. Even if you fell or fall in one of these categories here, I can definitely say if you fall in this category, you will be done in 1 year from now, because this is what I described in game 2. And option B here, I've lost already so much, so what's another €100? And then we're talking about what's another €1,000 here. I've already lost 10 grand. What's another 1,000? And what's another 5,000? I've lost so much already. The thing is that this is this is a phenomenon we call sunk cost fallacy here. And what I describe here is that this is what you play or go through here. You keep the bet on. Let losing trades run, since there's hope to turn things around rather sooner than later. That's usually also something from a psychological perspective, which is really interesting in terms of fear here. So usually you feel kind of adrenaline rush when entering a trade, especially when probably trading too big here. But, and this is the interesting thing, there is the moment when, well, things probably work out and you feel this kind of adrenaline rush and everything's still good, but then the market does not turn around, and you start to hope that things will turn around. And this is when your body starts to produce cortisol here, and you feel kind of paralyzed. So we won't go into too much details here, but this is usually what happens here behind the scenes and in your body the moment you are in this how we call this, when you're facing exactly this. So small probability risky bet with a case of losing. So sunk cost fallacy, keeping on a bet, you won't trade, you won't take the bet if you are standing outside of your trade. Okay, so right now you're looking at the market saying, I won't take this trade anymore. But if you are in this trade, you keep the bet on because you think, yes, but probably I can turn things around and probably it will work out fine. And if you have to get rid of one of those 4 cases immediately, even though you have to look at an optimization at the other 3 cases too, get rid of this one here. Risky bet in case of losing. This is definitely something you have to get rid of. So now the main question is, how do you profit from this knowledge in your trading? How can you do this? And let's start with winning streaks here first. So if you have a winning streak, you gain self-confidence, and you feel invulnerable. This is something I think completely human and completely fine. Now the thing is that you should start to induce rational thinking here, and you should find actively reasons why the next trade could fail. This is what we call pre-mortem analysis. So in fact, when you do this, sitting here and really thinking about, okay, what could go wrong here if I take this trade now, you will definitely never ever ever trade without a stop anymore, because if you are visualizing that you could be on the wrong side of the trade, then usually the thing is that you will definitely place a stop. And in fact, if you really do this very accurately, then you can also make sure that you do not fear any losing trades anymore, because the thing is you have already found actively reasons what could go wrong here, which will make you reduce the position size. And if you lose, well, you lose. That's it. That's, by the way, the same thing for the gold trade I already mentioned here. So I'm not just managing my mental game here with an adequate position size, but it's also true that I already visualized that it could definitely go wrong. That this idea probably does not work out, even though I'm highly confident that it could work out. Here I've presented several ideas on my view on gold here several times already in the near past, in morning meetings every day. So and I think I'm definitely having a good chance, a very attractive risk reward here of being on the wrong on the right side, even though I know that I could be wrong on this trade. There have been so many times in the past, hundreds of trades I made, and where I was confident that the market will play out, else I wouldn't go long or I wouldn't go short. But, and this is the thing, it didn't work out. So in fact, my hit rate is somewhere around 50%, meaning half the cases I'm on the wrong side. And so the thing is, if I do this pre-mortem analysis here and I visualize what could go wrong, I will definitely place a stop and make sure that I cut my potential losing trades short. On top of that, it's also if you grasp the concept of expected value here, and if you understand that trading based on cognitive biases will result in bad results here in the long term, well, this will definitely increase your chances of going broke. So we won't go into too much details here. So this is, by the way, something I've described already as the 3 columns of profitable trading I live by. And where it's at, it's not that those columns stand independently from each other. So trading psychology is one column. If you master it, fine. Well, you have a good chance of being profitable in trading. But no, you have to be a master here in terms of risk and money management too. So, and if you're a master in risk and money management, obviously you understand what is the expected value and what does it mean here in terms of increasing a chance of going broke, reach your point of ruin here. And this is obviously connected to the so-called payoff ratio. Oh wait, payoff ratio, that was the average gain divided by the average loss. Oh, by the way, average gain, average loss, didn't we talk about this earlier? Yes, we did. So look at this here, for example. Remember this chart. It's the average winning trade, the average losing trade. If I work out a ratio here, if I calculate a ratio, you can see that all the times through all assets, this ratio will be below 1. So what I do look for in my trading, for example, is I look for payoff ratio being bigger than 1. Minimum 1.5, more than that is better. It's even better, since this reduces the chances of going broke with my trading. Oh wait, if I reduce the chance of going broke with my trading, and I know this because I built this on a mathematical fundament here, and I can prove that I have a lesser chance of going broke. Well, this creates self-confidence. Self-confidence is something which plays an enormous role in terms of trading psychology. And here you can perfectly see already, we won't go into too much details here, but how these columns obviously interact with each other, and that you just can't look at trading psychology alone and think you're profitable. And even though some out there might say, hey, trading psychology is the most important aspect in trading, since trading is 100% psychology. Yes, I somehow know what's said by this, but even then I have to disagree, since I know how important, for example, risk and money management, but also trading with a positive expected value, respectively, a profitable trading strategy is. And now, the thing is, the solution, if you grasp this concept of expected value and understand it in depth here, well, then you have to make sure that you formulate a clear and well-defined trading plan, and you know exactly and really well what you plan to trade. And you have to test it, and if it works and is robust here, which means it has a positive expected value and a risk of ruin of 0, well, then we just go with it. And we keep trading through it every day, over and over and over again, not being a victim here to cognitive biases, all that stuff. And also, and this is the next thing, I highly recommend stop fighting writing your strategy and your trades down. So, I mean, there will be plenty of guys out there listening to this right now, and if I ask the question here, please raise your hands if you have a trading journal or not. Do you have one? I bet some probably might raise the hand, but even then, trading journal is not what I understand having a trading journal. So for example, my trading journal is not just writing down the entry, the exit points of my trading stop, this is the risk and that stuff. It's also included there, but nevertheless, I also write down how I feel. Do I feel good? Do I feel bad? What went good? What went wrong? So go in really depth here in your trading and really write down your emotions too, whether they are positive or negative. And the main reason, by the way, many people do not have a clear predefined trading strategy, but also a trading journal, is because they want to avoid to get a result here, which is showing that they're doing something wrong. It's kind of self-defense. Again, we come back to the cognitive biases here, self-serving bias, remember that. And so what I highly recommend is that you should make writing a trading strategy, respectively also having a trading journal here, make it something positive. So making mistakes and knowing them gives you a chance to change something and then get a positive result in the long run. A result which increases your expected value, and this said means that you become more profitable in your trading. And yeah, so with this, I'd like to end this presentation here. So I hope that you enjoyed what I presented to you here in this Black Friday special exclusively for JFD brokers. And I wish you happy trading all the time. Talk to you again, by the way, 1 week from now, next Tuesday, on the 5th of December 2017. And here again at 1 p.m. GMT. And then we'll talk about one of the other columns I already talked about. Obviously, risk and money management is also one of a very important and also one of my favorite topics, not just because of my mathematical background, but also because it makes sure that you always know, for example, how to optimally capitalize on your advantage you may have in your trading. And yeah, so that's it from my end. If you have any questions, please shoot over an email, contact me via Twitter, write a question here in this chat box here. Ask our experts in the secret trading room. You can ask the question here and get an answer immediately. So feel free to contact us, and that's it from my end. Have a nice day, happy trading, watch your stops, talk to you next week. I look forward to it. See you and bye-bye.